Well, good afternoon, everyone. Thank you for joining us for a conversation entitled Cryptocurrency, Partnering with Miners to Meet, and that's miners, M-I-N-E-R-S, to meet energy and environmental demands. I am Bob Rowe. I'm CEO of NorthWestern Energy. We're an integrated electric and natural gas company serving Montana, Nebraska, North Dakota, and Yellowstone National Park. And you may have read about some of our travails in Yellowstone Park in the area over the last week or so. I love the title because Butte, Montana is known as the mining city, where so much of the copper was mined and smelted that helped power a great deal of North America. And now we're talking about another absolutely fascinating kind of mining. So joining me for this discussion are leaders from two companies at the intersection of cryptocurrency and energy. Instead of reading their bios, however, I'm going to let them introduce themselves and their companies, as well as set the stage for our following discussion. Etienne Snyman is the Executive Vice President of Power and Applied Blockchain. And Etienne, before coming to Applied Blockchain, you worked in our sector at NMAX in ATCO, and we had a great discussion about skiing the Canadian Rockies. You're from Calgary, just before the start of the session. But tell us about your experience in the industry and how that informs your work at Applied Blockchain, and then tell us a little bit more about your company too, please.
Absolutely, thank you everybody for coming. So as Bob mentioned, I come from utility space, worked for the regulator, and then mostly in trading and then business development roles, building combined cycles, simple cycle, hydro, and transmission lines. And then about 5 years ago now, I joined the exciting world of cryptocurrency, data processing type of applications. It's been, my background in the utility space has been very helpful because the way we position data centers is in many cases such that we try to solve some of the problems that utilities have, because if we help them, typically there's some benefit in it for us as well. Applied Blockchain is publicly listed on the NASDAQ. We constructed a 100 megawatt data center in North Dakota, operational as of earlier this year. And late last year, we also announced the development of a 200 megawatt data center co-located with a wind farm in Texas, and more exciting news on the way.
Great, tremendous. Tad Piper, you're the CFO of Compute North, based in Minnesota. And we were talking about, again, travel challenges. You made it in one piece. Apparently your sport coat made it in more than one piece. And your background is in working with early stage companies, especially in software and technology, as well as financial and business analysis. So if you would, please tell us more about Compute North and how you're partnering with the industry.
Yeah, absolutely. So Compute North was really founded around the concept of building the most sustainable, low-cost computing infrastructure in the world. It really stems from our two founders, one who came from 25 years in the data center development space, and our other co-founder comes from the renewable energy development side as well. So from the very outset, we've centered the development of our company around the marrying of non-mission critical computing, what we call tier zero, i.e. Loads that can be curtailed, combined with partnering with the power sector to really hit head on the issues of the movement to renewables and really moving to a distributed environmental world. So my background, to your point, Bob, is really centered more around the innovation side of software, decentralized computing, as well as being involved over the last, I'm afraid to say it now, but several decades now, of partnering in areas of innovation to bring finance solutions to solve industry problems across multiple sectors.
Great. Yeah. Question to the audience: if you are confident that you fully understand blockchain and cryptocurrency, would you please raise your hand? Okay, there are a couple of very wise people in the audience, but for the rest of us, could you please just give us a working explanation of what is cryptocurrency, why is it significant?
I'll go ahead and start. I mean, I think at the risk of overcomplicating things, I think it's really rather simple at the very core of it. In the old world, essentially, if Visa wants to process a transaction with American Express, they go through centralized servers controlled by those entities. At the very basic level, I'll use Bitcoin as the most simple example, is it's really the opportunity for two parties who don't already know each other to conduct a transaction using the blockchain to validate those transactions. And then at the very core of it, mining, if you will, is the infrastructure that underlies that network in which those parties can transact at the very most basic level. And so what it's essentially moving, it's oftentimes referred to as decentralized finance, decentralized computing. At the very core of it, it's the ability for two parties to transact and have that transaction both recorded and security validated using decentralized computers.
Perfect.
Yes, and I'll add to that that mining provides the security to this system, unlike a bank or a Visa system where there's a centralized database where they have, obviously very sophisticated firewalls and security to protect it, but should somebody get passed through that, they can get into the database and change an entry and it's changed. For Bitcoin, for that to happen, a bad actor needs to accumulate, I think it's something like 70%. They talk about a 51% attack, but it's actually more, closer to 70% of the processing power. So for somebody to do that, they would have to build out gigawatts worth of data centers to then corrupt the system that it is they're trying to infiltrate, if you may. So there's a strong disincentive. You have to spend billions of dollars on infrastructure, equal amounts on the electricity to then break what it is you've just built. And that's sort of at the core of the Bitcoin security. So that's what mining really is. It's providing that security.
Great. When Bitcoin first became, I guess, publicly visible, there were a lot of really interesting discussions around what are the elements of a currency, the 5 or 6 things that really identify a currency. I don't expect you to recite all of those, but actually that's been a fascinating discussion as well. You could argue that Bitcoin might be a better currency option than several sovereign alternatives, depending on the economy. And then, of course, underlying that is the blockchain, and we still don't fully have our heads around all of the things that blockchain can enable and can also disrupt. I'd love any thoughts on that as well. A little bit off the energy topic, but.
Well, I think at the most basic level, what blockchain allows for is two parties who don't already have a pre-existing, shall we say, relationship to validate transactions. So applications in areas of healthcare where we spend a tremendous amount just validating transactions on an ongoing basis. Wouldn't it be wonderful to know what your doctor's visit was going to cost you before you actually receive services, as an example, which we've seen in other areas of healthcare, like pharmacy transactions and things. So there's a lot of promise around the ability to validate transactions using, essentially, at the most basic level, it's just a double entry database overall. To the point about the currencies and actually digital currencies being more of a currency than even some sovereigns, I love the commentary around things like, well, what's the inherent value of the Bitcoin currency? My common response is, what's the inherent value of the dollar other than everybody's willingness to use it to buy and sell things? We went off the gold standard a very long time ago. So this idea that we're underpinned by some hard mined asset at the outset seems like a little bit of a fallacy to me. Just one other point is, I would say that Bitcoin, cryptocurrencies broadly, obviously I'm the CFO, so I think about this quite a lot. I think there's a lot of discussion about what exactly the regulators want to declare that Bitcoin is. In Congress, for example, there's a very broad debate about, is it a currency, is it a commodity, should it be regulated by the CFTC, the Commodities Future side of the equation, is it a currency, should it be treated as a currency? The reality today is that Bitcoin is actually considered by accounting an intangible asset, which is the equivalent of it was described as somebody as the equivalent of a comic book collection on current accounting standards. Probably need to advance from that overall, and I believe that we ultimately will, so that we can get to a place where it is regulated more consistent with either being a currency in and of itself and regulated on a par with a currency, or a commodity and regulated on par with commodities overall.
Thank you. That's been a very helpful discussion, and if we're going to be your partners and your energy providers, I think it's up to us to understand your industry a little bit better as well,
Yeah,
sir.
absolutely.
So really do appreciate that. Now let's go back to energy specifically and energy demand and load profiles. Maybe a good place to start is just in terms of total consumption, because that's become a real point of contention in quite a few areas. And some people, for example, have put the entire amount of money consumed by Bitcoin in terms of, say, an entire national energy draw of a small country. Others have noted it's just about the same amount of energy that Americans use for Christmas lights, which could be quite a lot of energy. And those numbers may be the same, but what are your reactions to the debate, the total amount of energy that the industry uses?
There are many different uses of energy. We use energy for, luxury things like cooling as well. Bitcoin is about a third, or at least one of the estimates I've seen is about a third of the amount of power that goes towards cooling, air conditioning. Excuse me. In the U.S., in terms of the amount of consumption, the latest number I've seen from Forbes as of March this year estimates it at around 14 gigawatts worth of power. I think that's probably a bit high, to be honest with you, especially today, given just where equipment is with the same amount of, we don't have visibility into how much power people are using to do the mining, but we do have visibility into how much computational power there is on the system. And to get to that same level of computational power using modern equipment, it solves for about 6 gigawatts of energy, which is a substantial amount, but the energy consumption for your traditional banking rails, be it the machines that you tap at the cash checkout or the ATM machines and all the advertising, etc., must add up ultimately. And Bitcoin or blockchain has other applications beyond just those type of transactions as well. You asked what other uses there are.
Mm-hmm.
We are somewhat spoiled in the West here with having stable governments, etc. But in other places, people have lost land because a new individual would come into the government and say, I therefore deem this land mine. And the Republic of Georgia, for instance, they keep their land titles on a blockchain network, and they actually leverage Bitcoin security even for private blockchains, which is interesting. They call it basing, where every once in a while the private blockchain would write data to the Bitcoin blockchain. So if you want to corrupt the private blockchain that's used for land titles, for instance, you have to go corrupt the Bitcoin blockchain, which is of course substantially more difficult. So there are some more value being attributed or created by Bitcoin mining than just what you typically think of Bitcoin.
In countries such as Georgia, that's really one example of Georgia kind of rethinking digital government, and really very exciting in that way. Yeah.
So the Blockchain Mining Council estimates that the Bitcoin network uses about 0.16% of global energy produced around the world. Obviously, to Etienne's point, validating every last power usage across the network is a challenge, so it does look to aggregate that. It's also fair to say that while the total amount of hash rate or computing power on the network has increased, the power usage relative to that has actually decreased. So in a traditional technology basis, like all industries, and the sort of concept of Moore's law of the increased power of computing power and chips, if you will, we're very much on that trajectory. So the amount of ability to process transactions and use less power is alive and well within the overall Bitcoin network. Obviously, because the Bitcoin operations is just slightly more than a decade old, we get a lot of press around sort of emerging from nowhere to being 0.16%, if you will. The rebuttal overall to that would be, yes, it uses a lot of power. I've heard people in the sector call that a feature rather than a detriment, if you will. And I think to Etienne's point, it is the basis of how the security is created. But what I would say to those of you who are in the power sector is how many consumers of electricity are also willing to shut off when you call and ask them to? And so what I usually say to people in the power sector when they're thinking about a Bitcoin miner as an operation or a load within their overall portfolio of power users is, we're not a steel plant. That's what I say. Or a steel plant wants to run 24/7 and they shut off, their business interruption insurance is dire, right? Because everything comes to a screeching halt. That's not the case in the case of a Bitcoin mining operation. And I think it is that feature actually where you have a very large amount of load, but also with a flexibility to work very much in the challenges that we all face with the evolution of the power sector. I'll probably let Bob lead us down on that path rather than getting us there too quickly.
That actually was precisely where I wanted to go. So moving from the overall demand in the aggregate to the opportunity to think of you as a flexible load. And then if you could give us some guidance, some examples about how to structure the relationship between the electric provider and the Bitcoin miner to achieve that. And of course, this is incredibly timely given concerns about summer conditions.
Absolutely. Etienne, would you like to start on the power side?
Sure, happy to. So typically when I engage with utilities, the question to them is, where would you like me to be? And how can we most efficiently integrate with your system? And there are a few sort of pinch points that utilities deal with where we can add value. Some of them, the most notable is congestion. And so this is true for utilities as well as the IPPs. It's much quicker to build wind farms, solar farms than it is transmission lines these days. And there's certainly a number of places across the US and North America, for that matter, that has congestion. Locating load with generation makes a lot of sense. There are also some opportunities around dispatchable generation in terms of having to shut down a combined cycle plant every night and start it up every morning and incur the LTSA penalties and the gas costs and frankly the time to ramp and then not being available at 4 in the morning when you want that power to be. So creating an anchor tenant for some of that generation to flex that, use that flexibility. And as Tad mentioned, we are also extremely flexible when it comes to curtailment. So it's not that you forfeit that capacity. In fact, we can ramp down faster than gas turbines can ramp up. If given the right conditions, we can open breakers, and unlike a steel mill or a refinery, there's no long-term impact. There's no health and safety or environmental concerns associated with doing that. And then we also can work with utilities to make use of the capital that they've invested more efficiently. For instance, having substations that are not fully utilized. I've also come to learn that many utilities would build large transmission substations and they would include tertiary windings in the transformers that they never end up using. Well, we're very flexible, not just in how we dispatch, but also where we locate. We need electricity, we need internet, and there's a number of creative ways to get that. And then we need people, and in people, most of the resources there can come from rural communities as well. I've had good luck hiring from oil and gas sectors, from agriculture sectors. So these utilities would have capacity sitting there unused, and we're happy to go pay them to use it and lower the rates for everybody. So.
Yeah, I think a couple of things. I'll reiterate some things that Etienne said. I mean, at the very, very start, the whole premise of what we were building and what we've built at Compute North is the ability to bring the load, if you will, to the power resources. So we use a modular data center approach, which effectively means that we're already building our data centers today and then in partnership deciding where we're going to actually deploy those. So I think at the very fundamental basis, I think both of our companies' ability to bring the load to where it's most needed within the overall network is a really important feature, if you will. Normally when I get into this and people ask me about power, I geek out for a minute. This seems like an appropriate place to do so, if you will. I think, at the very highest level, my observation, and maybe this is the benefit of not necessarily being kind of growing up, if you will, steeped in the energy sector, but one aspect I would say is that the majority of the energy sector as a whole is one of the few sectors that balances supply and demand by only pulling historically on one lever, right? It's based solely on supply ramping up or ramping down in order to meet demand across the network. Now, that is obviously heavily complicated by the fact that supply in a base load world is throw more carbon in it, no problem, right? It's not always windy and it's not always sunny and the water's not always flowing, just ask people in the West Coast, right? So I think with that comes a new need for tools, and I would argue that across the US today, from a regulatory standpoint, each of you represents different players within the sector across the country. We have very different regulatory environments around where demand actually gets to play and where flexible demand, call it demand response, call it the participation in the energy imbalance market, call it whatever you want to in your local basis, if you will. But what obviously we're seeing is a large-scale push across the US to invest in renewables, and I would say less support to invest in the required spinning reserve capacity in order to keep the grid from blowing up. What that requires clearly is a development of a much larger demand response market in order to balance supply and demand and reduce the volatility between peak load and sort of base load supply, if you will. And so the most basic example I would give, we participate in Nebraska. We're a big partner with Nebraska Public Power District. We have a number of other partnerships that we've strategically partnered with. But as you all know, on a given day, it might be a gigawatt of usage across the state of Nebraska, whereas peak load might be 1.7 gigawatts. The ability to manage the difference between base load and peak load is where demand response offers the opportunity to move towards a future with more renewables without exacerbating the volatility across the overall sector. So I don't need to tell all of you that volatility is going up. Some of that is environmental, some of that is supply. Overall, if we don't embrace an environment where demand can actually enter the balance across these markets, the amount of CapEx that's going to be required well beyond the investment in renewables is going to be passed through to ratepayers overall. Again, I don't need to tell you your business, but essentially the ability to bring in consumers of power who are willing to partner and shut off and provide that ancillary service should be viewed by most of you as an opportunity to balance the grid without the millions and millions of dollars of CapEx to essentially have resources sitting idly by. So,
and unlike conventional, so demand response or load shedding has been around for a long time, and it's typically from pulp and paper mills, sawmills. We have the ability to be more precise and offer products that they couldn't. For instance, we can be frequency responsive. We can emulate what a generator essentially would do in terms of droop settings, etc. So more responsive than what most people are used to when they think about load shedding, and therefore spinning reserves. Regulating reserves, maybe a little bit less so because we like running base loaded, but certainly more.
So as the Bitcoin industry has become more sophisticated and as we've all become a little more seasoned in these relationships, I think your suggestions are that you can help us operate our systems more efficiently. You're potentially flexible in where you locate, so we can at least manage some congestion issues, particularly behind substations. You can potentially provide us a minimum requirement ability to operate facilities. And unlike a lot of loads, a lot of customers that might say, yeah, we're interruptible, when you say it, you really mean it.
Very much so, and it's been demonstrated in a number of markets where data centers provide auxiliary services, Texas, Alberta, etc.
A lot of us have had experience kind of in an economic development context, working with large potential data centers, the FANG companies or otherwise. Turns out they have obviously very specific needs in terms of transmission access, probably certain power quality expectations, but they also typically want extraordinarily high capacity, redundant tier 1 internet access, and oh, by the way, they don't want it to cross the Canadian border. So your load is different. Explain what it is about the Bitcoin, the mining operation that makes you a potentially attractive customer to locate to one of our service territories, maybe compared to one of the high-end data centers even.
Well, I'll start with, so the data center space is based on, as I like to say, no, uptime is next to godliness, if you will, in the traditional data center space, right? So, they'll have redundant, power feeds, sometimes, obviously going to have generator backups, sometimes double generator backups, all the way up to tier 4, which is going to have, hot swappable computing power, Kevlar walls. I was recently at a data center. I was wondering which armed insurrection convinced everybody that they needed Kevlar walls, but that's indicative, if you will, of the level of redundancy and high level of service that's demanded. The concept of tier 0, which is what, a phrase that we coined a long time ago, is to juxtapose non-mission critical computing to that very highest level of redundancy in the sector. And so, what we're essentially trading off, if you will, is the cost of uptime, or the exponential cost of 5 nines of reliability, and trading that, if you will, for opportunity cost, both in terms of power as well as computing. The long-term vision is, as we move to a world that actually embraces distributed computing, is actually really what blockchain allows is that in a traditional sense, traditional computing, redundancy is at the hardware layer. Its redundancy is at the data center. In a distributed world, redundancy is at the network. The most striking example of that, and the most real-world example is over half of the Bitcoin network came offline when China shut down operations. And there was no press stories about the fact that the Bitcoin network came to a screeching halt. The Bitcoin network just kept operating. There were fewer nodes, if you will, on the network. But because of decentralized computing, it just kept operating. And it is that promise of moving from a centralized world, both in distributed computing, so centralized to distributed, is the parallel move that we're seeing on the power sector as well. So we're moving from a centralized baseload world to a distributed distribution. And it is actually the crashing together, if you will, of those two massive trends that I think is going to fundamentally change the computing market over the next decade.
You're right in that redundancy is, on the electrical side, is not that important. We don't seek redundant supply. We don't implement redundant systems on our distribution networks inside the fence either. But we do have a different relationship with utilities, or we prefer to have a different relationship with utilities when it comes to interconnections, in that we don't like building substations. It's not our business. It's not what we want to do with our capital. And
You got out of that business.
Yeah, exactly. So we don't want to do that to the extent we don't have to. We would if that's what's available and makes sense. We'd prefer to be more creative with utilities and think through how can we get the capacities that we're looking for, which is typically in the hundreds of megawatts, at a more manageable voltage that we can step down to 415 directly, as opposed to having multiple levels. So a few places to get that. One is, like I mentioned, the tertiary windings on some of the transformers where you have it at 34.5 kV. Also, co-locating with generation provides that as a benefit as well. There's the fact that in some cases you avoid transmission charges, which is great, manage congestion. But another attractive part of that is being able to get large capacity service at 13.8, 20, 34.5 kV. So we are, that saves us in capital, and therefore we are, willing to compensate for that service.
Anything to add there?
I think it's well said overall. I think that we as a business have been, look, we need to find a relationship that works with the power provider. So I think I would agree with Etienne in that, all things being equal, we would prefer not to build a high voltage substation to step it down to intermediate voltage, but we have in certain instances in order to do that. I think that, it's about finding the right balance in that relationship overall. I mean, at the end of the day, it comes down to both sides determining what the appropriate return on capital is overall. So, sitting with my finance hat on, if the deal is right and I have to come up with the capital to build the substation versus the power provider, that's just a discussion about cost of capital and risk sharing overall. All things being equal, I would agree that we prefer to take things at mid voltage overall, but that hasn't really been a requirement, if you will. I think it really comes more down to most conversations historically over the last several years very much start with a retail playbook. Come to a power provider, they say, okay, I've got, here's my rate schedule, here's all the things that come with it, and usually the discussion says, well, what other value can I bring to you? And I would say at the outset it was like, have nail hit with hammer, right? You need load, I have a schedule here, this is what it is, which includes things like, I'm going to pass through to you the ancillary service charge. It's interesting. I'm potentially your largest provider of ancillary services. Is that just a rebate on the payments that I'm making to you as a provider? If I'm offering it, should I be paying for it too? So those are the kinds of questions that I think that we've asked over time, and those who have entered into that conversation. The example I would give is our relationship with Nebraska Public Power. With the movement to need to embrace demand response, we allowed a provider like that to essentially enter into a single bilateral agreement and sit alongside of their spinning reserve requirements, and we now provide essentially demand response on parallel with spinning reserve assets within the SPP network to deliver those services. That's a really good example of an evolution of our relationship with a power provider to sort of start in one place, but continuing an ongoing conversation to truly create the value that we both bring to that relationship overall.
That is a great example of the industry maturing, and of the relationship maturing alongside that. A lot of the discussion around Bitcoin recently has been around the decline in price, but for perspective, last time this meeting occurred in person, June 2019, Bitcoin was at about $8,000, and in that perspective, maybe you're doing okay even now. But what impact do price fluctuations have on your business and therefore on energy demands?
So we certainly have some exposure, there's no way around it, but it might not be, or it is not as bad as it would appear. As long as you are sort of a first quartile, low cost operator, and that's maybe one of the cues to give you an idea of, you know, whether the counterparty you're talking to is there for the long run or not, is whether they have the patience and the sophistication to drive for a price that's more competitive. And the reason I say that is that there's a fixed amount of Bitcoin is minted every day, and that is shared across the network to all who participate in the computational power. So when you see the Bitcoin price decrease, there are ultimately some miners who would shut off their machines, and those are the ones who are running the older machines and the ones who are exposed to higher electricity market prices. And then as they turn off, the Bitcoin, its same amount is still minted, is then being spread across fewer other miners. So the ones who continue to operate actually benefit by getting more Bitcoin earned than they did before that. For instance, Bitcoin price went down here over the last week by about 30% or so. And you saw the Bitcoin network hash rate come down as well by about 10-15%. So that means we're now mining 10-15% more Bitcoin for the same input as we did last week. So it has this self-levelizing aspect to it. And again, the ones you'd expect to come down would probably be the ones who are connected to distribution systems, paying the regular rate, which is 8, 9, 10 plus cents. Leaving the ones who have the prudence to and the size to get the lower capital with more. Anything to add to that?
Yeah, I mean, so one thing I would say, and what's interesting is obviously we represent businesses who are very much in the infrastructure side of the equation. So actually, our customers are in fact Bitcoin miners, where we provide that service versus being a fully integrated business top to bottom, where we're investing both in miners themselves as well as the infrastructure. And it is that kind of distinction that I would say when you're thinking about counterparties is for a long time there have been a lot of miners out there who, and many of you have probably received calls from lots of these people that say, hey, I really want a bunch of cheap power. And what I would generally say is, as you all know, you may want to sell power and a Bitcoin miner might want to plug their machines in, but there's a lot of wood to chop between high voltage power delivery and actually plugging a miner in scale, right? And so both of our businesses are built on the concept of, there's sort of been this simplifying of the fact that we build data centers. Building data centers is complicated. There's a lot of infrastructure that goes into that and a lot of experience that goes into that overall. Specifically, to get to your point around profitability, what I would say is that we've gone to a point where profitability for a period of time, sort of in the golden age of mining, was really in the last 18 months, if you will. That means that you've gone from a sector that had very, very high gross profit margins to one that has lower profit margins. In fact, I would argue over time that that's a logical evolution of the sector. And it actually makes Bitcoin miners better partners to the power grid. And I say that for a very important reason. If it's not economical to Bitcoin mine on a megawatt hour basis, the Bitcoin miner is actually a better buffer to power market volatility because they actually are interested in shutting down, particularly to the extent that they're the cheapest alternative to an alternative source of power. So for example, if Bitcoin mining, I'll use an example from a couple weeks ago, its opportunity cost is $180 a megawatt hour in producing Bitcoin, they're economically incentivized to get out of the way if the real-time cost of power is exploding. It is exactly that relationship that is really, really important to have what I would call cost-centric offtake is exactly what the power sector needs to reduce volatility. Like, I want demand to disappear when power prices are spiking. Everything in the market today is incentivized to increase supply. What we need is actually more people that get out of the way on the demand side in order to reduce that volatility. And so I would actually argue that some of the recent changes, using a very kind of scholarly approach to looking at it, is exactly what the sector needs, particularly on the power side, to reduce the volatility that you're all experiencing.
So I would attempt to summarize a couple of the points here. First of all, this is a classic pattern you would see in a new and maturing industry. Secondly, the rules of economics very much apply to this sector, just as to traditional sectors. We all have lots of experience working with large C&I customers. There is certainly a perception that the Bitcoin industry presents some significant credit risks. I think this conversation has really shed a lot of light and I think advanced understanding. But just respond to the to that perception. What should electric companies do to mitigate actual risks or to deal with what may be simply perceived risks?
I think the first step is to not invest a significant amount of money in the capital to serve that power, which sort of complements our ability to locate anywhere. You don't have to build a significant transmission line or a substation to serve us. So really you have very little capital at risk. And the costs that you do put at risk, a prudent or a sophisticated company would recognize that and would be able to think through and work with you on backstopping that through various financial securities, be it letter of credit or otherwise. And then just providing the flexibility to the Bitcoin miners as well. There are different ways to operate these machines that solve for different economics. So enabling some of that flexibility on dispatchability and where the load comes in helps that facility also weather storms. And the simplest is just sell them power for very cheap, and then they'll always be there.
Yeah, so I'd make two comments. One is that our customers print money for a living, so you can decide what that credit risk is. Just one way to look at it. I think the other is that I would argue that your C&I traditional credit risk is changing, and it's changing because of volatility. So your counterparty risk with a Bitcoin miner is that when the price blows out, they're going to get the hell out of the way. I think what you saw in Texas during Uri is that your traditional C&I risk is actually higher than you perceive it to be traditionally because of power volatility. Now, that's going to be different in a market like ERCOT than it is in a regulated market where regulated markets are going to smooth that out. But all I would say is the difference is ERCOT solves that problem every 15 minutes. And the regulated markets solve it every year. It's just the period in which you're looking for a payback is different. But nonetheless, the credit risk around traditional offtake, I think, is changing as a result of volatility.
Great. Actually, let's go to the question of vertically integrated versus restructured markets. You both play in both fields. Say just a bit about your experience in the two market designs and what you're looking for.
Sure. So when I think restructured markets, I tend to think volatility, which we've discussed here extensively. We're able to optimize our operations and our exposure to volatility. Unlike many other customers, because we are so capable of managing that through curtailment, auxiliary services, etc. It's not overly intimidating to us. Vertically integrated markets, you know, you tend to associate with more price stability. The key there, I guess, is again to be just in jurisdictions that are, you know, low-cost jurisdictions to be in. Some parts of the U.S. are more blessed with natural resources or generation sources, for that matter, that just complements better what we do. Other parts of the U.S. is just, you know, not viable for us to be at. But when it is a regulated market, it's just to have a counterparty or a partner that is willing to be creative and to explore how we can add value to them.
So at a very high level, I think we can talk about broad-based systemic risk, if you will. Obviously, you know, we provide, you know, what we call sort of a shock absorber to the grid overall is the way we describe it. But at a very micro asset level, I actually think that the biggest value we can bring is to those who own renewable assets. You know, you're all facing, you know, basis risk, congestion risk. You know, I think a lot of the tax equity has forced a lot of people to take out hedges, and now you're wearing all that basis risk. Bringing the load directly alleviates part of that. These are the solutions where I think there's the best opportunity for us to work to actually offload some of that risk, if you will, by eliminating some of that. So I know we're short on time. I'm happy to catch up with any of you afterwards, but I'll leave it to Bob to wrap us.
In just a second, I'm going to ask you for any parting words of wisdom to an electric company audience. Any quick questions as we wrap up here? Here's the microphone. Good, right up here. If you could introduce yourself and give us your question.
Michael Quinn, Shareland Utilities. So on a given day, make it a week or a month, whatever interval you want, how many times a day are you prepared to go up and down from a you know, shed load or, you know, full out kind of scenario? I'm trying to get a load profile of y'all on an average day.
It's a good question, and to some extent, I think we do ourselves a disservice by perhaps talking about curtailability and how good we are at it. We are a high capital business, and the expectation of our customers is that we have a high uptime. So I've kind of beaten the curtailability drum before, and then I get a proposal back that says, great, we can give you a good rate. You just have to turn off 8 hours every day. Well, that's not going to work either. So what we're really trying to do is to maximize or use our ability to curtail and provide that capacity in a manner like auxiliary services where you don't actually have to do it all that often. So we're still looking for a sort of an annual uptime in the high 90% number. And there is some delay when it comes to ramping up and down in terms of the ramping up. So we're good at ramping down very quickly, but it's not something where we want to ramp down for 10 minutes, ramp up for 5 minutes, and ramp down again for 10 minutes. We prefer, you know, ramping down for a few hours on the hottest days or the coldest days or the most significant days, in a manner that, again, overall solves for 97, 98% uptime on an annual basis.
I think to summarize it quickly, I think generally speaking, we're not looking at the outset to be frequency control. And I think to Etienne's point, we're prepared to ramp up and ramp down, all things being equal. 1 time a day is far better than 5 times a day. That does not to say that we couldn't do 5 times a day, but we really would prefer the other end of the spectrum. And I think also we're looking to be able to be in a situation where we're appropriately incentivized to get out of the way, right? I think that's an important aspect of entering into any relationship.
One more question?
So I'm Pasi Taimela, CTO of FlexGen. I have a question about, like some other bigger data center developers, they're talking about 24/7 real-time renewable power. Like, how do you see, like, in a tier 0 data centers, regulation to have all real-time renewable power? Like, do you see batteries coming to play in the crypto mining data centers?
I think there'll need to be grid backup. I haven't seen a case where partnering or combining batteries with renewable generation makes sense from an economic standpoint. So it's typically involvement from a utility to provide that firming service. There are some opportunities to undersize the data center relative to the particularly wind. If you have a 200 megawatt wind farm and you put a 100 megawatt load there, it's call it a 40% capacity wind farm, but because it's so much less, you can get sort of 2/3 of your power from that wind farm, as opposed to just the capacity factor number. But ultimately, given the uptimes that this industry typically needs, you need another source to firm that. If it's intermittent resource, hydro, of course, is a different story. But
I'd simply say this. I would argue that I have yet to see a particularly compelling model around battery underwriting based on merchant demand, right? A battery might last for an hour. During Uri, we were off for 4 days. Now, I'm not saying I want to be off for 4 days, but the fact that we could highlights the fact that we're a very different solution to a 1-hour battery solution. So I would actually argue that a tier 0 data center to some extent might replace the need for a battery on the network rather than being complementary to it.
Great. And my last question, just quick parting thoughts to help us do a better job working with you.
We're more creative than your typical and more flexible than your typical customer. So as Tad mentioned, typically approaching utility and the standard rates is what's being offered. We can provide a lot more value to the utilities and the suppliers than those customers. So the willingness to sort of explore around the edges, I think, can create a lot of value for all parties involved.
Yeah, I think what I would say generally to that point, really to follow on that is because we're relatively agnostic to where we go within a particular power network, overall grid overall, the opportunity to actually partner on meeting common problems and solutions is actually far more where we sit. Whereas I think your traditional customer says, here's my address, I need power, here are the things that I need. We're much more willing to come in and say, where would you like us to be? What are the patches that you need, et cetera? And I would say those who get us more quickly to that discussion, we're growing both of our companies very quickly. Kind of working through the 8 months of trying to get higher ups in an organization to get to that level of flexibility, the faster we can dispense with that and get to a kind of business problem solving together, our whole businesses are based on problem solving given how fast both of our businesses have been growing overall.
That's a great metaphor for your product as well, truly. So I have learned, I imagine most of us have learned a great deal about the technology, the evolution of your business, and how we can be very good partners working with you. So please join me in thanking our wonderful presenters.
Thanks, Bob.